Hello students, you are the future chartered accountants of India. I am CA Abhijith Acharya. Welcome for today's Abhi CA classes. We are going to complete the capital gain chapter in this part 3, and without wasting further time, I will start the today's topics. Exemption available to individual or HUF. Section 54, it says it is applicable only for individual or HUF SSEs. The transferred SSE should be the transferred asset should be the long-term capital asset. It means the transfer means the residential house property being building and land appertinent thereto. That building and land appertinent thereto should be long-term capital asset. The whatever you are selling should be long-term capital asset in order to claim the exemption under section 54. Then what is a new asset to be bought? That is a condition. One residential house property in India needs to be purchased or constructed. If the world long-term capital asset should be the land or building appertinent thereto. The new asset should be bought is also a residential house property in India needs to be purchased or constructed. But there is one point: if long-term capital asset is long-term LTCG after LTCG is up to 2 crore. LTCG means after reducing cost of acquisition, indexed cost of acquisition, or indexed cost of improvement, you will arrive at the long-term capital gain, right? Then that should, if it is up to 2 crore, then SSE can acquire 2 residential house properties instead of 1 house property for his lifetime benefit. Afterwards, he cannot again claim this benefit with regard to this again considering 2 properties. It is for entire his life. Okay, this benefit is given. The time limit within which that house property should be purchased or constructed. The purchase within 1 year before the date of transfer. Let's say, for example, you are transferring your old long-term capital, that is house property, on 1st January 2024 in 23-24. Within 1 year before that means that means on or after that new house property should have been bought on or after 2nd January 2023, because it should be within 1 year that should be bought, or you can purchase within 2 years after the date of transfer. That means within 31st December 2026, if I'm not wrong. Yes, within 2026 you can purchase. You have to purchase a new house property. Okay, if you are going to construct that house property, that should be constructed within, that construction should be completed within 3 years after the date of the transfer. That is within 3 years means on 31st on or within 31st December 2023, it should be that property should be constructed, right? Okay. Then deposit scheme. There will be the deposit scheme. The definition will be covered in the next points. The capital gain account scheme, CGAS. It is simple short. The amount of exemption is capital gain or cost of new asset or CGAS. That is what you have been deposited in CGAS. That should be whichever is lower will be treated as your exemption portion. Then restriction. That is on restriction. If new asset that has been purchased or constructed, no, that is transferred within 3 years from the date of purchase or construction, then cost of acquisition of a new property shall be reduced by exemption capital gain. Okay, that's a clause, because you have to hold that new house property up to 3 years only. If you are going to transfer the new house property, then exempted portion can be reduced from your cost of acquisition. I will take one example. HP sold in 23-24, that is 50 lakh. Indexed cost of acquisition is, let's say, 30 lakh. Then LTCG is 20 lakh. Under section 2054, you have purchased one house property, that is 20 lakh. So 20 lakh benefit exemption has been given. So the net taxable amount is nil. In 25-26, within 3 years, you have sold that new house property 20 lakh for 60 lakh amount. But the indexed cost of acquisition is, let's say, 20 lakh. But the 54E, that is mean the the reduction of that is exemption portion 54. The exemption portion is 20 lakh. That should also be reduced. So entire 60 lakh is to go into tax in that year. So for that reason, you have to hold that house property at least for 3 years. Afterwards, you can claim that indexed cost of acquisition. Okay. Then section 54B, capital gain on sale of urban agriculture land and use it for another agriculture land. Okay, that is applicable for individual or HUF. Then long term, that transfer asset can be long term in nature or short term in nature. The transfer should be agricultural land used by an individual or his parents for agriculture purpose within 2 years before the transfer. That agricultural land should have been used for agriculture purpose only. Okay, the new asset should be the agricultural land, the rural or urban land you have to buy. Okay, so then time limit will be the new agricultural land should have been purchased within 2 years after the date of transfer. Okay, this is the best clause. Then deposit scheme. Deposit scheme also applicable. That is CGAS, the capital gain accounting scheme, that also been applicable here. The amount of exemption will be the lower of capital gain or cost of new asset or whatever amount deposited should be less, whichever is lower. Okay. Then restriction also applicable here. If new asset is transferred within 3 years from the date of purchase, then cost of acquisition of new assets should be reduced by the exempted capital gain. Okay, the exemption you can consider from the above section, the same that should be holded up to 3 years. That's it, the simple concept. Then section 54D, the compulsory acquisition of industrial land and building. SSC is any person. It need not be an individual SSC HUF only. It can be any person. Company also, partnership firm also, any person in his no name. The asset should be the short-term capital asset or long-term capital asset, whatever may be the capital asset. The transfer should be the compulsory acquisition of land and building which was used by the SSC in the business of industrial undertaking during the 2 years prior to the date of the transfer. The condition is same like that 54B. In that agriculture purpose, it should have been used. In this, it should have been used for industrial purpose within 2 years before the date of the transfer. Okay, the new asset should have been bought is new land and building for the industrial undertaking. Okay, the time limit should be purchased within 3 years from the date of receipt of compensation, not from the date of the compulsory acquisition. Within 3 years from the date of a compensation. Okay, very important. The deposit scheme also applicable. The amount of exemption can be the capital gain or the cost of new asset or whatever have been deposited, whichever is lower. Okay, then there is also a restriction. If new asset is transferred within 3 years from the date of purchase, then cost of acquisition of new asset to be reduced by the exempted capital gain that has been claimed earlier. Okay, this is all about section 54D. Next, section 54EC, investment in certain bonds. SSC can be any person. The LTCA, that is long-term capital asset, should have been transferred in only that is land, building or both, any of the both. But new assets should be bought which are redeemable in nature after 5 years. The following bonds: National Highway Authority of India, in short NHAI, Rural Electrification Corporation of Corporation Limited, in short RECL, Indian Railway Financial Corporation Limited, in short it can be also short RFIRFCL, then Power Finance Corporation Limited, that is PFCL. Okay, in these bonds you can invest within 6. The maximum you can be invested is 50 lakh. If you invest 1 crore, then that is restricted to 50 lakh. In order to check, can be claimed if it is invested within the time limit. The time limit is within 6 months from the date of transfer of original asset. Okay, this is very important. Within 6 months you have to of the transfer date, you have to purchase that bonds. Okay, the deposit scheme is not applicable if you are going to deposit that amount into the capital gain scheme. Then this benefit will not be applicable because the time duration is very short. In you can see, you can compare this section with other section. In the other section, the time limit is almost within 2 years or 3 years, and hence the capital gain scheme is applicable. In short, what do you mean by capital gain scheme? Is simply because you are not in a position to build a new property within immediately, or within you cannot purchase a new property, you cannot construct a new hospital within that date. So in order to claim that benefit, the CGAS, because you need to file your income tax return in the next assessment year, right? Because in the next assessment year, you are not in a position to purchase or construct a new house property, as we have discussed in the last sections. So for that reason, in order to provide one benefit for the SSC who has been charged for that capital gain, he is available. He is having an option that the entire capital gain amount can be deposited. Entire sale process can be deposited in one account, that is capital gain account scheme. You can deposit in SBI, for instance, because there is every scheduled bank there is this provision. The bank CGAC account, it should be under your name. That's it. Okay, in order to provide that benefit, because within the due date of your filing of income, you need to disclose that I am going to claim this section, and hence I am not in a position to build or construct or purchase within this period. So because 2 years or 3 years is there, so for me, so in order to disclose, in order to claim that benefit section, I am going to deposit that amount to this respective bank account. But for 54 each, that benefit is not applicable, because within 6 months you have to deposit in the four bonds, right? So the time duration is very short, so that benefit is not relevant for this section, so it is not applicable here. Amount of exemption is capital gain or cost of bonds up to 50 lakh, whichever is lower. Capital gain, let's say for example 40 lakh, and then the cost of benefit of bonds is 50 lakh, and should be whichever is lower is 40 lakh, you can be available with that exemption. The restriction is if new asset is converted or transferred within 5 years from the rate of acquisition, then exempted capital will be taxable in the year of such conversion or transfer. Okay, very important. You need not to convert any of the bonds. You should be holded within 5 years, up to 5 years, because it is redeemable up to 5 years, right? Starting from 5 years, right? So you have to hold that bonds within 5 years. That's section 54. Capital gain on sale of long-term capital asset, any long-term capital asset, but you should purchase the residential house property. You might be seeing that there is a similarities between section 54F and section 54. That's the first section, that the house property. But in there is one saying you have to sell that residential house property. But in these sections, you can sell any of the long-term capital asset, but the purchase should be same. In that also the purchase should be same. But here the selling can be anything which are in long-term capital asset. The SSC should be the individual or HUF. The asset transfer should be long-term in nature. The transfer should be any long-term asset, not being the residential house property, because if it is a residential house property, there is a confusion between section 54 and section 54F. So here it is clearly said that it should not be any long-term capital residential house property. Okay, the new asset should be the one residential house property in India. The time limit should be the purchase, if it is a purchase within 1 year before or 2 years after the rate of transfer. That give example I have already given in section 54. Then the construction should be completed within 3 years from the date of transfer. Okay, the deposit scheme is applicable here also. Don't worry, because amount of exemption, it is very important. This is little bit different than any of the above sections. Okay, the cost, that is proportionately you are going to avail the exemption. The exemption amount will be the cost of new asset into capital gain, that is after reducing entire the cost of that acquisition, cost of improvement. You are availing, you are claiming that you are actually arriving that capital gain, right? That you have to take divided by the net consideration. Net consideration means the sale proceed, that is FVOC minus any transfer expense. That is called net consideration. That should be divided in order to arrive at the amount of exemption. It is proportionately they have given. In section 54, in everything, whichever is lower concept will be applicable, but here proportionately amount should be taken into consideration. The restriction, the new asset is transferred within 3 years from the date of the purchase or construction, then exempted capital gain will be taxable in the previous year of the transfer of new asset and treated as LTCG. Okay, simple. There are some notes applicable for this exemption section. Section CGAC, I have already disclosed, I have already explained. It is applicable for section 54, for section 54B, 54D, 54F. Okay, the investment needs to be made in the specified assets as specified in the respective section within the date of filing of income tax return, that is 31st July or 31st October as the case may be. That should be deposited within the date of filing of income tax return. If you have not filed your, if you have not deposited within the date of that actual filing of return date, then the exemption won't be given for you. So it should be kept in mind. You have to deposit in this capital gain account scheme within the due date of filing of income tax return. That's it. Then new important. There's one new important is there. The CG, there is one new amendment. The capital gain in excess of 10 crore would not be taken into account for the purpose of depositing capital gain account scheme. It should be restricted to 10 crore. If you are making the capital gain accounts depositing more than 10 crore, then that is not allowable. It should be restricted to 10 crore. In case of section 54, but the net consideration in case of more than 10 crore in case of section 54F. Why the net consideration is taken in section 54? Because section 54 you have just seen that the proportionate amount is available as an exemption, right? So and hence for that reason that formula is applicable. In case of 54, more than 10 crore is not allowed. In section 54F, more than 10 crore net consideration is not allowable. Then non-utilization of balance in CGAS. If the amount deposited is not utilized, we have claimed an exemption by simply depositing that exempted amount or sale proceeds in the capital gain account scheme. But we are not utilizing that fund in order to fulfill that. What is the intention of depositing CGAC? I have already explained. The intention is we are not in a position to immediately purchase or construct the respective respective assets within that date, and hence we are depositing, and accordingly we are claiming an exemption. But if we are frauding, if you are not fulfilling that condition, that is, if you are not utilizing that fund in that account in a specified time, then that amount will be taxable as a capital gain. So exempted portion was there, no, that would be taxable in the capital gain in the year in which the time has passed away, expired. That is within 2 years, within 3 years, the respective house property or any of the respective is to be purchased, no, or constructed, no. If it is not being utilized within that day, within that time, then that exempted portion should be treated as an taxable gain. That's simple. The note for section 54, that is, these notes are only applicable for section 54F. On the date of transfer, the assessee should not own more than one residential house property. There should be only one residential house property. That's it. Should not purchase any other house property within 2 years or construct 3 years after the date of transfer. The simple concept is he should be owner of only house property at that time. That's it. If above two conditions are not complied, then exempted capital gain will be taxable in the previous year in which such other house property is purchased or constructed. Very strict policy. Then this point is only applicable for section 54EC. If assessee takes any loan or advance on the security of the bonds, that he has to purchase some of the bonds, right, within 6 months. If he has taken any loan or taken any advance against that bonds, then he shall be deemed to have been converted that money and he is not fulfilling that within that restriction was there, no, that within 5 years you need not to actually you need not to, you should be complied with that. Within 5 years you need not to convert, you need not to sell those bonds. That is been attracted, that has been deemed to be attracted, that's it. If he takes any loan against that property, then exempted capital gain claimed earlier is now taxable, that's it. Then section 54H, there may be some extension of time duration for acquiring a new asset, where there is a transfer of capital asset by a compulsory acquisition. It is only applicable compulsory acquisition. Then time limit for acquiring new asset or depositing in CGAS shall be computed from the date of receipt of compensation, not from the date of compulsory acquisition, because you might be not in a position to receive deposit entire, because you are not availing any of the sale proceeds, because you are just transferred your capital asset by way of compulsory acquisition, but in exchange of for which you are not receiving any of the amount. So CBDT has clarified through section that you have you have to compute the capital from the date of the receipt of compensation, not from the date of that compulsory acquisition. Okay. Then section 37, exemption of capital gain in respect in case of urban agriculture land, LTCG or STCG on compulsory acquisition land of urban agriculture land shall be exempt if the following conditions are satisfied. SSC should be individual or HUF. The such land should be used for agriculture activities for 2 years prior to the date of transfer compulsory acquired. The consideration is determined and approved by RBI or central government. That's it. If you are satisfied with 3 conditions, then compulsory acquisition of urban agriculture land also will be exempted. Then we are going to come. All the theoretical parts are over. Now we are going to complete some of the practical aspects in terms of tax rates. Section 112A that we have already discussed in our first basic chapter, but for simplicity's sake, I am going in a very speedy manner. Don't worry, the electricity on transfer of equity shares, equity oriented funds and units of business trust is in excess of 1 lakh. Up to 1 lakh, that is exempt, shall be taxed at 10% if the following conditions are satisfied. STT paid on acquisition transfer of equity shares. STT, that is security transaction tax, should be paid on transfer of equity oriented fund and units of business trust. Note, LTCG on shares which are recognized in a stock exchange located in International Financial Service Center, IFSC in short, would be taxed at 10% only, where consideration is received through in foreign currency, even though STT is not being paid. There's one benefit given for IFSC. The deduction under chapter 6A is not allowed. The rebate under section 87A is not allowed against this 112A section. Then section 55A, the cost of acquisition, because this 1 lakh exemption is being given from the Finance Act 1920. Okay, effective from 1st February. So up to 31st. Simple, I have made one clarification. It should be a 2. Okay, one. It should be 2. 1 minute. Okay. If any, actually, in case of any equity shares or a unit of business trust on unit business trust, refer to section 112A, acquired before 112. It is not 112. It is 1/2/2018. It is not 112. Okay, it is 1 February 2018. Sorry for the spelling error. Which is 1 February 2018. Cost of acquisition shall be higher up. Why it is provision is given? Because up to 31st January 2018, all the long-term capital asset transfer which are covered in these sections, equity shares, equity oriented mutual businesses, are fully exempt, irrespective of the 1 lakh limit. But first for February 2018, this brought into account up to 1 lakh it is exempt. More than 1 lakh it is not exempt. It is a 10% tax rate will be applicable in excess of 1 lakh. Because some of the investors were holding from 31st till 31st that January also, and if they were going to sell after that the date that 1st of February 2018, they would be charged with the tax. To provide that benefit for them, that concessional, that is incidental concessional rate has been given into effect. Okay, whichever is higher, they have been mentioned. Cost of acquisition should be increased to this formula. Actual cost of acquisition, actual cost of acquisition or lower of the below, that is fair market value as on 31st January 2018 or sale value FEOC, whichever is lower, the lower amount should be compared with actual cost of acquisition, whichever is higher shall be treated as cost of acquisition for the computation of this capital gain, long-term capital gain. If it is more than 1 lakh, then for excess amount 10% would be leviable. If it is up to 1 lakh, then exempt. Simple. Cost of acquisition or the lower or the below, whichever is higher, should be taken. Lower or the below is concerned FMV as on 31st January 2018 or sale value, whichever is lower. That lower amount should be compared with the cost of acquisition, whichever is higher, then that is amount should be treated as cost of acquisition for the computation of capital gain. Okay, indexation benefit would not be given in case of version 112A. Okay, then computation of FMV, we are just seeing that FMV should be taken. How to arrive at FMV? If it is a listed shares or units of recognized stock exchange as on 31st January 2018, you can easily take from the index, the BSE or NSE market, highest quoted price as on 31st January 2018. What is the highest quoted price as on that? Then you can take that. If there is no trading of your shares on that date, then the FME shall be the highest quoted price on a date immediately preceding 31st January 2018, where the trading had been taken place. Okay, then if you were holding that units shares not listed on 31st January 2018, in case of units, that's a mutual fund, then FME shall be the NAV, that is net annual value, on 31st January 2018 should be taken. In case of shares not listed on 31st January 2018 but listed at the time of transfer, for them the cost of acquisition, actual cost of acquisition, and into CII of financial year 17-18, because this amendment has been brought into effect in 17-18 financial year. So for that it runs CII, the cost of inflation rate of 17-18, that is for your purpose, your kind purpose, we have mentioned a 272 divided by, I think it is better to remember for your examination also. Okay, divided by CII of the first year in which the shares were being bought on 1st February 2018, whichever is later should be taken. Okay, then section 111A, the tax on short-term capital gain for transfer of equity-oriented fund, equity shares, business trust at the rate of 15% if SHT is paid on transfer. Benefit of this section would be applicable for SARSC situated in IFSC even though SHT has not been paid. The deduction of the section under chapter 6A won't be given for you if you are having STCG gain under section 1111A. Other capital gain, the tax rate would be the LTCG 20% under section 112, the STCG normal slab rate. Okay, proviso to section 112. In case of LTCG on equity shares, zero coupon bond, SSC can pay the tax at his convenience, that is 10% without indexation benefit, or the 20% with indexation. If he have to estimate what is my source, what is my ultimate income, in which in each of the options, where he finds that in which options he is going to tax very low tax amount, he can use that. There is one options available given for him. Okay, then in case of non-resident and foreign company, then 10% of the tax on LTCG from the unlisted security shares without first and second proviso to section 48. Okay, then there is one benefit of basic exemption limit against section 112A, 111A. Only for these sections that basic exemption limit can be availed. In case of resident, we are using the word resident individual achieve if balance total income, if other total income excluding this 112, 112A, 111A is less than basic exemption limit, then an exhausted basic exemption limit can be used against 112A, 111A, 112 income. That's a simple thing. We'll take an example. If LTCG at the rate of 20% is 2 lakh, Other income is also 2 lakh. So my entire income is 4 lakh. You can see my other income other than that 112, 112A, 111A is below basic exemption limit, because the basic exemption limit for me in my example is 2.5 lakh. 2.5 lakh, but in my case other income is below 2.5 lakh. To the extent of 50 lakh extra, I can utilize that 50,000, not 50 lakh, I can extra use that 50,000 against the 112, 112A, 111A income. In my case that is 112 income is there, so I can utilize that 50,000 against 2 lakh. So other income, you can see 2 lakh, entire basic exemption 2 lakh, up to 2 lakh it has been utilized. A balance 50k is still pending. So you can utilize that unexhausted basic exemption limit against the 2 lakh. So you can arrive at 1,50,000. For that you are going to charge 20,000, that is 30,000 tax plus 4%, so that is 31,200 is the ultimate tax you can. Otherwise you have to utilize, you have to pay 2 lakh into 20%, that is almost 40,000, right? 40,000 you have to pay, but in this case you are going to save 10,000 plus 4% assess, you are saving that amount, right? Then section 55A, a reference to valuation officers. Assessing officers may refer the case to evaluation officers in the following circumstances. Number 1, assessee officer is of the opinion that value claimed by the assessee is at variance with fair market value. We have already discussed that in some cases valuation officers can be utilized if assessing officer SSC is in conflict with the consideration of fair market value as a fair value of consideration in order to compute the capital gain. So if the assessing officer can proceed with valuation officer's value. But in case of any other cases, if fair market value as per it is for simplicity, you can just once read and leave it. If fair market value as per the assessing officers is more than value claimed by the assessee by 15% of the value claimed by the assessee, or 25,000, whichever is lower, in that case also we can refer to that. And having regard to the nature of the asset and as a relevant circumstance it is necessary to do so by the assessing officers, then he can approach valuation officers value. Then taxation in case of liquidation. In case of company, as per section 46 subsection 1, where asset of capital company is distributed on its liquidation, then distribution shall not be treated as transfer. It is simply a gift. It's simply on its purpose. Capital gain will not be applicable. Okay. In case of shareholders, distribution shall be treated as deemed income under section 222C, which we are going to discuss in IFOS chapter, income from other sources chapter, where shareholder on liquidation receives any amount or any assets from the company, then the capital gain is taxable in the hands of shareholders in the following manner: amount received plus fair market value of assets received on the date of distribution should be added, minus amount assessed as a deemed income as a dividend under section 222C, so should be reduced, then that is called sale consideration. Any capital cost of acquisition and the indexed cost of acquisition can be reduced, then you will be arrived at STCG or LTCG. Okay. Then period of holding shall be taken from the date of acquisition to the date of liquidation. Okay. The capital gain is applicable in the hands of shareholders in the year in which he received the asset under liquidation. Okay. The cost of acquisition of assets received under liquidation is fair market value of such on the date of liquidation. Whatever amount, whatever asset he has received in while the liquidation, if he is going to sell that asset received in a subsequent year, then what would be the cost of acquisition is its fair market value on the date of liquidation should be taken. Okay. Then taxation in the case of buyback of shares by the domestic company, listed or unlisted by domestic company. In the case of company, the domestic company shall have to pay the tax at the rate of 23.296% of the amount that has been bought. How the 23.29 has been, if you take the calculator, 20% plus 12% on that plus 4% on that, on both 20 plus 12, you will be arriving at 23.296 that the company is going to tax, and hence the company has already paid the tax. The bought back amount received by the shareholder is fully exempt under section 1034A. What do you mean by distributed income? distributed income 23.296 on the distributed income. Okay, what do you mean by distributed income? Means the buyback price minus issue price including premium. Okay, what do you mean by buyback? Means if any company thinks that it wants some of the amount in hand now, then it can bought back the amount from the shareholder. That's called buyback concept. Okay, I'm not going deeply into that concept. You are going to learn in your accountancy subject. Okay, then and hence it is fully exempt in the hands of shareholders. Note the redemption of preference shares also amount to buyback of shares. I hope we have successfully completed the capital gain chapters. And if you have any doubts with regard to this capital gain chapter, you can approach me in my provided mail ID or LinkedIn or Instagram in my provided in the description box. And it has been, but I request you to revise several times this con because it is very important chapter from your exam perspective, and also attempt the mock papers that has been conducted by ICAI. You can also write the mock test by approaching to our nearest centers, exam centers, nearest branch offices. So I request you to revise several times. And signing off, see Abhijith Acharya, Abhi CA Classes. Have a nice day.